Assalamu alaikum, distinguished guests, ladies and gentlemen. This is clearly the graveyard shift after lunch, and I hope my presentation will wake you up. Certainly, it's a pleasure to be back in person in the region after, I would say, 2 years travel drought, and it's equally exciting to be in a country that is clearly going through a transition. The 2 years pandemic had put a brake not just on Saudi Arabia, but across the world. So my presentation today, I'll try to be a lot more upbeat than we generally are. We're well known at The Economist for raising the red flags, alarming everyone, and seeing where it heads. So I'll try to be as upbeat as possible, but I wouldn't do you justice if I kept it all optimistic. So bear with me. It'll be worth it. Okay, so where are we? 2022, post-pandemic recovery. The world opened up gradually, but nevertheless opened up, vaccinated, ready to move again. What happened? February happened. Unexpected. Of course, we never got it right either. We didn't expect it. We were raising the flags of it, but certainly weren't brave enough to make a call on it, that Putin would go full-blown into Ukraine. Tipping around the toes, 4 months of build-up. The signs were all there, but I think the world did not want to look at that closely. Why? We'd just come out of the pandemic, the most brutal, unexpected, exceptional lockdown in the world. The last time we'd seen anything close to that was the Second World War. We're not used to it. We don't want to be used to it. So where are we? It has clearly shaken the world, and I would say taken up a lot of global leaders' attention again. How to deal with the war? What are the consequences? And I'll shed some light to it in our slides following this. What it has done is created an upheaval. And here, top of the list, like it or not, it's here to stay. At least for the rest of this year, spilling into the next 5 years. This is not going to just peacefully end as Putin would like it. Very, very difficult to see how this will go. But one thing all of you, whether you're an investor, policymaker, just the average Saudi citizen around the world it is, this is going to reshape with whom and how business is done as international relationships and alliances are reassessed. We got a window of that right at the beginning of the conflict at the UN. Where do they sit? And it was very divided. And you could see deglobalization taking shape there. In a decision about whether you supported the Ukraine war, whether you were with the West, or whether you're aligning with no one, where you're taking a neutral stand. In the coming months, this will be forced onto countries to make the stand. And I'll come to that in a moment. War scenarios, we had to scratch our heads as well. Where is this heading? We're not war analysts. This is where the security forces come in. Nevertheless, we do forecasting, so we have to make a call. So what you need to do at the top of the agenda is Putin's war of choice in Ukraine. Is this the final act of post-Cold War period? Or is it the beginning of a new era unwritten? Spectrum of possibilities. We've got 5 scenarios there. Right? It's like Russian roulette, whichever one goes. This is very much like that. Top of the scenario 1 is the most likely that we've identified. Why is that? The West was very quick at imposing sanctions, quick off the mark. Not as far as they could go, but certainly it's the beginning. It is also difficult to see how Putin wins. The longer it drags and the more resources are taken up. But he cannot accept defeat either. Of the 5 scenarios, what you need to do is look at it and say, does it predict the future? Or is it just an area for you decision makers to imagine could happen, what could be next, and devise ways to prevent the worst case scenario? And the worst case scenario is number 5. What is the worst case scenario? NATO gets involved. Wars can be broadened, quickly becomes a bigger and deeper conflict, just a flick of an accident. A NATO plane gets in the wrong place at the wrong time, and that would be it. We're not saying that's going to happen. First scenario, keep it in mind. Russia's overwhelming military superiority cannot be underestimated. Yes, they're struggling. His initial plan was 5 days maximum, in, out, within 5 days. That has not happened. Where are we now? End of May. The casualties, the pictures coming out are horrific. The cost for Russia is immense, not just in the army, but across the economy as well. Putin has shown he's willing to go to great lengths to achieve this goal. It's a personal agenda there as well. By using lethal force against the civilian population of Ukraine, the coming months are likely to be tougher. It'll get a lot tougher before we can see the exhaustion of the war finding its own way. A much weaker Russia will emerge, hit hard by the sanctions, definitely by EU closely speeding up their program of reducing their dependency or completely changing from Russian gas. 40% of EU's gas comes from Russia, the needs. So where is that Russian fiscal gas deficit coming from? The Middle East will be the future that we're looking at. Certainly this is in a strong position to fill that gap, but it'll take time. So what does this mean for the global implications? We've talked about inflation earlier this morning in a number of the sessions. One of the direct impact of the conflict has been on the global stage, has been financial sanctions, higher commodity prices, and on top of that, what we were still working through, the pandemic-induced supply chains. The disruption continued there as well. It wasn't what it was about a year ago, but definitely what it meant was a break on the supply chains as well. So the combination of the three has been pretty lethal, and we've seen prices rise. Yes, commodity prices, agriculture, oil prices, all of them. Commodity prices will continue to rise, energy, food, and metals. Oil prices, we've seen them at the highest level in almost a decade, 50%. Nobody expected that. That's good news for the oil producers, fantastic news. And we'll come to that in a minute as well. Prices of agricultural commodities, base metals, all of them have gone up by 30% in 2022, on top of other large rises in last year. This is a double whammy. This is, keep in mind, post-pandemic recovery. This is a huge challenge for the world to deal with. Inflation has risen to levels not seen for decades. Rather synchronized, I would say, in global fashion. Pushed up by higher energy and food prices. Global rate, we're forecasting to average 8% this year. It will be the highest rate in 26 years. Once again, keep post-pandemic in mind. This is a catch-up. It will hit consumers, policymakers, investors, companies. What does it mean? The reaction from the policymakers has been pretty quick. prompted all the Western central banks to tighten monetary policy. This was going to happen even without the war, except it's going to be a little bit more aggressive now. US federal raise this year, 2022-23, 300 basis points. You'll see that coming. ECB will also discontinue QE in June this year and raise rates 3 times this year and 5 times next year. Asian central banks, they've been reluctant and slow to move on this. They will follow the hawkish path as well eventually. So bear that in mind. Inflation, commodity prices, interest rate. The combination of the 3. Okay, moving on. How could we forget the pandemic? It's in a much, much better place. Otherwise, we wouldn't be here today, all of us, in person. We're certainly in a better spot with the pandemic, vaccination, particularly in this part of the world. They were very, very quick with the lockdowns, vaccination rates, and continued to tighten measures as and when needed. So, highly responsible. What you have to bear in mind here, why have I flagged this when things are moving, is we are not out of the woods. It's still there. Why? China's zero COVID policy is a drag on global growth. All right? Shanghai has been in lockdown for 6 weeks, finally opening gradually between now and end of June. Shanghai is not only the business hub where the global manufacturing industries depend on, the dependency has increased in 25 years, but also is the economic hub of China. You cannot ignore China. China is one of the key global economies. It has announced a phased reopening. It will also, as part of their COVID zero policy, if they feel they need to lock down again, for short periods of time, it will. This is their key policy, and it will go into 2023. We have seen the port operations opening up as well. They continue to remain open, but the activity has been much slower. And this is we go back to the supply chain disruption. Happened during the pandemic, a number of containers, ships are still stuck there. Takes time for the circle to start again. Severe disruption in trucking activity, weighing on industrial activity and exports. So what do you expect? Things will improve. It's not all grim in the coming months. But the disruption to global supply chain will remain in the short term, in the coming months. Normalization of supply chain will remain and is unlikely to return to pre-pandemic levels until the middle of next year. It doesn't happen overnight. Lingering effects of the pandemic and war, that will also continue. We have talked this morning about a session was on localization. This is the buzzword everywhere you go in the world, whether you're in the East, West, Middle East, or Africa. Localization, moving away from your supply chain, takes a number of years to shift away and serious investment. It does not happen in the short term. Nevertheless, this is an area that is going to be right at the top of the agenda of all the policymakers. Do not put all your eggs in one basket. The pandemic clearly showed us. Similarly, vaccine rollout, relaxing government policies, except in China. This could create a new variant as well. It hasn't run its course yet. You could see lockdowns happening even in other parts of Asia, Singapore, Hong Kong, Malaysia, Indonesia. But there'll be short periods, not like what we experienced in the last 2 years. So what does it mean for global growth? A busy chart there. Looks like human chromosomes. And it is very much that. We're all linked. No matter how much you say you want to decouple, you're not. Everybody is linked one way or the other, directly or indirectly. We're forecasting global growth now for this year, 3%. This is a downward revision from the beginning of the year, 3.9%. Important to take on board, we are not anticipating or currently forecasting a recession, global or in major regions, this year or next year. But, big but, risks weigh on the downside. Never take your eye off the ball. Middle East, you can see from the chart, Middle East, Asia, Africa will retain the fastest growth in economies this year, speeding ahead, much of which is linked to commodity prices. It's a substantial boost, a bonanza year for commodity prices, whether it's oil, metals, or food. So if you're a commodity producer and exporter, it's a win-win, at least for this year and next year. But bringing China back into the equation, it's a slowdown there. So that will have an impact on demand as well. We expect the economic impact of Ukraine and Russia war continuing. Both Russia, you can see, and Ukraine will go into double-digit recession for obvious reasons. Rest of Europe will take a hit, largely by the energy sector, trade shock. Eurozone growth of 2.3% this year, which is very much, before the war broke out, we were forecasting 4%. So we almost halved it. In the coming months, the risk is shaving it more based on how things move. Elsewhere, war-induced drag will be largely from the higher inflation. You can see inflation is just feeding through. Everybody's alarmed about it, and you are going to see how policymakers deal with it and its impact in the second half of this year. Will it lead to a recession, mild recession, technical recession by the end of the year? Currently we're saying no, but it could tip it over. Mild, short, sharp recession, okay? Higher interest rates will not be a good thing either. From a regional perspective, just want to highlight one major thing, and you can see from that chart, I've broken it down by the regions around the world. Certainly, I would say, looking through this lens, we can see MENA performing, Middle East and North Africa, performing very well, but tailing off in the later years on the back of falling commodity prices and demand. Asia will remain a key growth driver for the global economy, even with softer markets in China. US will achieve a soft landing as well. And Europe, modest recovery from the dip from this year in the coming years. So you can see where this is going. Positive, we're not talking about negative growth here, but certainly a slowdown and break. Quickly looking at some of the major risks to take on board. Russia, Ukraine war, NATO gets involved. It's a big one. That would definitely tip the world into deep recession. This is not our central forecast. This is certainly not our alternative. I would say that's the worst case scenario. And let's face it, very much hope we don't have to tackle with that. Russia cuts gas supplies to Europe before Europe has had a chance to diversify its needs. Industrial production in Europe will come to a standstill on the back of that as well. So thirdly, highly aggressive, another variant emerges. Fourthly, US and China, once again, vying for global influence. Once again, go back to deglobalization. This will be the buzzword in the coming years. I can see my time is ticking away and I've got a lot more to do. What's in store for Middle East? Good news. Fastest growing region, as I said, commodity boom, vaccine rollout. You can see the energy, the bars as well. A number of projects that were put on hold, the break that was made in the last 2 years, they're speeding ahead now. not just in Saudi Arabia, but across the region, particularly the GCC. They're the net beneficiaries of economy that is surging on the international energy prices and, of course, very lucrative policies as well. There will be a time when they will have to put a brake on it if commodity prices fall drastically. And this is the worst case scenario, which we're not looking at the moment. Okay? Middle East, we've already covered how the reliance of the Western reliance on energy on Russia and also the impact of sanctions. This will support new commercial opportunities for the Middle East. And when I'm talking about what does it mean for the Middle East, the strain in Europe will be the opportunities for the Middle East. So there's a yin and yang. A great time for countries, other countries, to take up on these opportunities. High dependency on food imports on Russia and Ukraine, on grain. We've seen that taking place. This is an area that could create greater opportunity to diversify your food needs as well. This is the next big thing for the world, is the global food security. It is not just about commodity prices, it's about the impact of the climate change taking place as well. Yes, Russia-Ukraine war has created 3 million tons of wheat deficit this year, and it's going to be 4 million next year. This has a direct and indirect impact across most of the economies around the world. Saudi Arabia, what's in store? Good news. We've talked about the high oil prices, steadily rising oil output. We're estimating or forecasting real GDP growth of 6.7% this year, fastest since 2011. And 4.7% next year, averaging about 3% in the following years. It will be led not only by the high energy prices, but several huge infrastructure projects, substantial opportunities for investors and contractors, construction activity. There's a catch-up time now. What was put a brake on the last 2 years, they're going to speed ahead with it from this year. And we've heard about the different sessions this morning, and before my session, the projects which are in the pipeline as well. PIF is investing in infrastructure, private sector activity is rising, manufacturing, tourism, right at the top of the agenda. This is new. It will happen. Mining, renewable energy, on the back of very supportive policies from the central government as well. Saudi Central Bank, an interest rate will reach about 3.3% this year by the end of the year, in line with the way the US Fed moves, okay? Keep an eye on that. Overnight difference there. Riyals pegged to the US dollar will not change, will remain, which has been in place since 1986. Okay, Project RHQ, we've talked about that initially. This is a key driver. It's a carrot and stick approach. Foreign companies to establish the regional headquarters in the kingdom, preferably not just Riyadh. This is a misconception with investors. They seem to think that only Riyadh is going to be growing and developing. This is not the case. It's right the way across the kingdom. And the regulations is not just restricted to Riyadh and said, this is where your headquarters has to be. It can be anywhere in the kingdom. This is a misconception by investors. Keep it clear, you can go anywhere where there is development taking place. Okay, failure, carrot and stick approach. This is where I come in. If you fail to establish a regional headquarters in KSA by January 2024, would it exclude you from the big ticket projects? Yeah, highly likely. You have to stay committed if you're going to establish. This is a region, country in transition. Transition takes years. to take place. Along with that is regulations on the back of that. Very, very important. Some of the big ticket projects are going to be, you're going to be seeing major global city economy, placing Riyadh among the world's 10 largest economies by 2030. On the back of the population growth, youth, very, very important, development taking place, high tech. So the combination of the three is going to place Riyadh at the top of the league of 10 global economies, city economies. Very important, city economies. In the future, you'll have to stop just looking and measuring the climate of a country by just the GDP numbers. It will be the cities you'll have to look at closely. Then you won't get it wrong. But if you just look at the country numbers, you will be off the mark. Okay? And as I said, some of the transition period will require regulation changes. What keeps investors awake at night? And I've listed some of them that we found in our experience, that we do know the policymakers are dealing with them. Top of the list is labor market costs, which are high, and skill sets that are required by investors, local and foreign. This is not just about foreign investors, it's domestic investors as well. So this is right at the top of the list as well. Payments, may I whisper it? Yes, this is an area that investors find they struggle with. And I do know that regulators are dealing with how to speed up the process. So some of the key concerns and things that keep you awake at night are listed there. They're all being looked at carefully, closely, and making the necessary changes in line with the projects which are taking place. Won't happen overnight. Bear with it. All right? Okay. What are the key things I would say that you need to, in line with all the development that's taking place? There's no doubt. The kingdom is reshaping for its business environment, its business climate. One, to boost the private sector activity, to attract foreign companies and domestic companies. This is a major economy. When you look across the GCC, yes, there are the other business hubs. But with this development, can Saudi Arabia become the next major business hub? I would say yes and no. Yes, if it speeds ahead with everything that's on the table. No, if it leaves it any longer. But certainly the commitment, the policy and the execution is there. They've streamlined business startup processes, procedures, easier to secure permits and approvals as well. E-governance is going to be improved. You've seen customs clearings taking place faster, removed cap on foreign ownership by publicly traded companies, introduced new residency permits, developing the local capital markets. Very, very important for private sector activity. You cannot come here if you do not have a sophisticated financial sector. It goes hand in hand. Also, support for the small and medium companies, including fully foreign-owned startups. Privatization, PPP, is also going to be the next big thing. This is something new taking place across the kingdom. Okay? Got time? Very quickly, these are some of the key areas regulations will have an impact on. You can see the transition in the medium term, this year, next year. Following years, the impact of those changes will be pretty radical for the wider economy. It's not shifting. Okay. Very quickly, this is a tourism, hospitality sector, and I feel that we have to touch on it. What does it mean? Where we come from? You can see I've done a chart with no COVID, what it would look like, tourism sector. Bear in mind what I said earlier, we're not out of the woods. If we're completely COVID-free, you can see the tourism sector flying away. Definitely, I would say the tourism sector has been the last sector to recover from the pandemic. We are forecasting tourism arrivals on the road to recover fast. The sector will be the last to return to pre-pandemic levels at a global scale. This is not about just this region. Certainly what you're going to see is international arrivals recovered in late 2023 and into the early part of 2024. Mass vaccination, vaccination passes, reopened of the borders. These are all the key things which has been immediate recovery. That's why we're all sitting here. Unheard of even this time last year. Impact from the conflict of Ukraine. What we've seen is that it has had a limited overall impact. Even traveling within Europe, we've seen the numbers rising to France, Germany, Italy, Spain, Portugal. So you can see that the pandemic has not scared the international travelers or the hospitality sector. Tourism has definitely picked up. We expect this to continue well into 2024-26 as well. On average rising by about 6% a year, okay? In terms of revenue, inflation will boost the nominal revenue, but in the second half of the year, there will be cautiousness as inflation bites the consumer spending power, all right? The consumers face a double whammy of weakening purchasing power and higher interest payments. This is the first time in a number of years that both inflation, interest rates, and a number of global risks are more or less in tandem. You can survive it, you can ride it for short, sharp periods, but it cannot be sustained. You will see the impact of it. This could really spell trouble for the aviation industry, high energy prices. There's got to be a balance between the supplier and the consumers there as well. It has to be balanced in the interest of both parties. So that is another area that needs to be worked at. Higher input costs, particularly for companies. We talked about restaurant business this morning, hospitality sector, hotel industry, aviation. Everybody is experiencing at the same time higher operating costs. So this profitability bottom line could be eroded. There'll be cautiousness, but I'm not saying there's going to be a break on travel, on the tourism. This will continue to rise. There's also the psychological, human element. We've been locked up for 2 years. It's time to move. It's time to see it's important. Also, where is the spending coming from? The last 2 years, what we found is the financial sector, particularly the deposit of the individual rose because they're working from home. Deeper pockets, they're being spent, particularly in the West. All right? Quickly, looking at the tourism, Middle East is recovering the fastest. Major plans to boost tourism. We've heard about the plans of it in the longer term, especially in Saudi Arabia and other GCC states as well. But the biggest ticket projects, some of them are here, biggest ticket projects are in Saudi Arabia. If you look across the region, this is where they're just dipping their toes in the waters. A lot more to be done, and they're going to be happening. Some of the projects you're going to be seeing is about tourism development, boosting the sectors to GDP to about 10% of the GDP by 2030. That's a double digit. That's a pretty heavy weight. Not only will it be part of diversification, but it'll create jobs. A very important policy agenda as well. You will see considerable logistical, financial hurdles overcome. Larger construction projects likely to end up either being taking ahead or speeding ahead. Very much will depend on how commodity prices and the global economy moves as well. And I've listed some of the projects to look out for are the King Abdulaziz project for the Riyadh public transport, connectivity, tech connectivity, transport connectivity, all of those areas are going to be very, very important and great for investors. Okay, key takeaways. I've listed some of the things. There's no question. Saudi Arabia is going to be able to offer foreign companies access to Riyadh-based and other major giga and mega projects. And this is something I like to repeat. It's across the kingdom. Riyadh is not just Saudi Arabia. There's a major cities being developed right the way across the kingdom. Look out for the projects in the pipeline, including the Red Sea project, NEOM, right at the top, incorporating the lines, revamp of the economic city concept, Riyadh, Jeddah, Mecca, and Medina, plus industrial free trade and special economic zones. This is all new, very important. And of course, the added bonus of accessing largest market in the Middle East, and one that we increasingly integrated and interconnected with other GCC states and the wider Middle East. Okay. So the bottom line, as investors and hospitality sector, for the coming short term, I would say keep three things in mind, 3 R's. Recovery, rates, and of course, I can't get away without saying risks. Okay, thank you very much for your attention.